Hello, good morning, afternoon, or evening, whatever the case may be when you get to this. Again, I'm Phil Perkins. I'm your instructor for Accounting 2410. If you see me looking off camera a little bit, it's because I'm reading from a script that I have attached to the PowerPoint presentation. So I'm not going to spend much time talking about myself. My profile is out there on the blackboard. If you can't get to it for some reason, let me know. I'll just say that I've taught accounting before on a number of occasions, but this is my first time at Northwood and my first time using the blackboard. So, as I expressed in one of my announcements, there may be a few growing pains associated with that, so please bear with me. I promise not to say that again. I'm excited to be teaching this particular course because it's changed so much over the years in the manner of presentation. When I took what was then called Accounting 101, the Principles of Accounting course in the 1970s, which kind of dates me a little bit, the professor literally stood on one side of the room and told us that that is the debit side, and the left side that is, and then went on the other side of the room and told us that that is the credit side, or the right side. And it went from there, rote memorization of many details. By the way, I'm just on the intro slide, which is slide 2 of the pack, and I'm going to move to slide 2. And slide 2 shows the study objectives for this chapter, chapter 1. In approaching the course initially from a higher level, more general standpoint, like this text seems to be doing, it will, I think, help you to understand eventually how accounting fits into the bigger picture of a business, maybe more so than starting with the details. So these are the 6 objectives we'll be discussing in Chapter 1. First, we'll cover the primary forms of business organization, and there are 3 of them: the sole proprietorship, the partnership, and the corporation. Obviously, the corporations take up the lion's share of the business, the dollars, and the transactions in this country and in most countries. We'll then identify the main internal and external users of accounting information. These are the people who need to understand what the accounting information is telling them, and they put a great deal of reliance on the reliability of accounting information. There are 3 principal types of business activity, and this has a lot of bearing on accounting information and how that information is presented, as we'll see a little bit later. Fifth, we'll explain the meaning of the basic building blocks of accounting information, that is, assets, liabilities, and stockholders' equity, and how these building blocks relate to each other in a basic accounting equation. Finally, we'll talk about the financial statements and supporting documents that form a typical large publicly traded company's annual report. I'm now on slide 4 of the pack for Chapter 1. We already mentioned the 3 forms of business organization, and they're presented on the left of this slide. Users are internal, such as executives and managers who need to know how the company is doing financially in order to better do their jobs. If you go on to managerial accounting, you'll see how the financial information is broken down further into departments for cost and management purposes. But for our purposes, we're looking pretty much at a company-wide view. External users may include actual or potential investors, creditors, suppliers, and regulators, amongst others. Ethics in financial reporting has received increased emphasis in recent years as a result of the Enron, WorldCom, and other major company scandals that hit us in the earlier 2000s, and were the impetus for the Sarbanes-Oxley Act, which requires management attest that their internal control structures assure accurate financial reporting. One of the companies I recently worked for is a publicly traded company that had to comply with SOX, and believe me, that was a real effort to get controls that many of which had been used for a long time, but they had not been documented, they had not been formally tested to make sure that they actually worked in the way that they were supposed to prevent a financial misstatement from taking place. So let's now turn to the three business activities that we'll be coming back to quite a bit in this chapter, and again as the course unfolds. Financing activity includes borrowing from outside parties and helping establish the business or expanding it. Investing involves the business making significant expenditures on property, plant facilities, equipment, etc. Operating activities are the day-to-day actions that are performed in support of the business's objectives once it's been established and is up and running. Accounting information is communicated to users via financial statements. The income statement, the retained earnings statement, the balance sheet, and the statement of cash flows. And we'll get back to these and start to talk about them and their descriptions a little bit later. And how they're interrelated with each other as well. Other elements of the annual report include the auditor's report, the management discussion and analysis, and the notes to the financial statements, each of which we'll discuss in more detail a little bit later on. I'm on slide 5 now. The sole proprietorship is what is often called the mom and pop shop because, generally speaking, these are smaller businesses such as restaurants, bakeries, barbershops, and so on. They're relatively easy to establish and they pay lower taxes normally than a corporation. So that's a couple of advantages. Partnerships are also relatively easy to establish, and they have the advantage of having more than one person to share control, finances, and a broader potential range of skills than a sole proprietorship. It used to be that many legal and accounting firms were partnerships, and some still are. Many have reverted to, or evolved, I should say, to the limited liability company form of organization, which, as the title implies, helps to limit the partner's liability. Corporations are generally larger than partnerships or sole proprietorships, and the ownership is dispersed among the shareholders, none of whom have any personal liability for the debts of the corporation. Of course, the shareholders bear the risk of losing market value on their shares should these shares take a downturn. And on slide 6, this is just a kind of a visual showing some of the typical internal and external users, and these are talked about also, of course, in the text. Consider what uses each of these parties would have for financial information, which I think is outlined pretty well in the text. For example, the marketing manager would want the information to get some feel for how a product should be priced, just as an example. A regulatory agency would perhaps want to see the financial statements to make sure that it appears that tax laws are being complied with. On slide 7, here are several examples of internal users and the questions that they need financial information to help them answer, as we just brought out a couple of examples there. Keep in mind that these are being looked at from a pretty high level in the company for our purposes, as the financial statements cover the financial condition of the company as a whole. Moving to slide 8, this chart shows the typical questions that external users may be asking investors. Investors want to know how profitable a company is because that is a key indicator of where their stock price and dividend payouts may be headed. Creditors want to know how capable the company is to handle its debt load before they decide whether to extend additional credit. Onward to slide 9. The above example shows the importance of accounting information and keeping not just executives and managers, but all employees involved in company operations. By posting operating results for everyone, employees can get a better idea of how their contributions affect the company's success and profitability. Please review the question asked at the bottom of the slide and consider other benefits of making financial statements available to all employees. Is it just a matter of transparency, or does it really affect the employee's ability to perform their jobs and maybe be more motivated to understand why they're doing what they're doing? Okay, on slide 10, this slide shows the pervasiveness of accounting information in a business and why it's so important to so many career fields in business. Although accountants are often referred to as bean counters and not necessarily in a complimentary manner, many accountants develop strong business knowledge through the work that they do that gives them opportunities to move up the corporate ladder into advanced accounting or even non-accounting positions. Slide 11, as mentioned previously, Enron, WorldCom, and other financial scandals in the early 2000s were the catalyst of sweeping regulatory changes that promoted tighter controls over financial reporting, the Sarbanes-Oxley Act being the most significant. All U.S. publicly traded companies must comply with the SOX Act in preparing their quarterly and financial statements and reports. Slide 12. This slide illustrates steps in solving an ethical dilemma. It's important to note that professional accounting and auditing organizations have codes of ethics that their members must comply with. This normally includes a requirement for some ongoing ethics training that would include case studies and examples of real-world situations of potentially unethical behavior and how it was dealt with. Slide 13. This slide discusses the importance of accounting for a not-for-profit organization, that it's important there and not just for profit-making businesses. If the not-for-profit does not report its results accurately, whether the result of fraudulent activities or just honest mistakes, these things can hurt its credibility and negatively affect its ability to raise funds. Slide 14, the SOX Act does require management to certify the accuracy of its financial information on a quarterly and an annual basis. The penalties for fraudulent activity, sometimes referred to as federal sentencing guidelines, increase to further deter this activity. Independence of auditors was increased, an example of being the forced rotation of auditors after 5 years, perhaps it's less than that now, on one particular assignment. So in reviewing this question again, the tax rates on corporations, there was no bearing on that as a result of the Sarbanes-Oxley Act. Slide 15, we've already described these three types of business activity. They will become a greater point of emphasis when we discuss the statement of cash flows, one of the 4 financial statements you'll be learning about. The statement of cash flows is the most clear-cut example of the statement on the slide that the accounting information system keeps track of the results of each of these business activities, but the other financial statements also in their own way keep track of them as well. Slide 16, a description of financing activities. A business can borrow funds for startup or expansion purposes. Notes payable are typically more short-term debt for purchases of equipment, furniture, autos, and so on. These may be short or long-term liabilities depending on how long the repayment period is. Bonds payable are longer-term debt securities sold to investors that must be repaid at a particular date, some years normally into the future. So bonds payable are typically long-term liabilities, except for the portion of them that is payable within the current year. Publicly traded companies issue shares of stock to raise funds for financing, investing, and operating purposes. Dividends are normally paid on a schedule, usually quarterly, to shareholders of record. Dividends are not considered an expense, but rather a reduction in the retained earnings of the company, as we'll see again later. Slide 17 discusses investing activities. As stated in the text, once the company has raised funds through financing activities, it then uses that cash to invest in the things that are needed to operate the business. Typical examples of which are shown on the slide. The key takeaway on this slide is the last bullet, that resources owned by a business are called assets. As a former boss of mine once said, to emphasize a point, you may want to tattoo that one to the inside of your eyelids for memory purposes. Also, file this away as well. The company still considers a resource an asset, even if it still owes money on it. I think you can reflect on that in your personal life if you're a homeowner. The home is an asset that you own, even though you have a mortgage on it that might still have a significant balance due. The debt that's owed in the business situation for an asset will be shown as a liability, and you'll see how this all works out a bit later. Slide 18, description of operating activities. And when operations begin, the business starts producing its product or services for sale. Revenues represent the amounts earned from selling the products or services. Interest earned on investments are also considered as revenues. For businesses that sell physical products, inventories represent the goods on hand for sale to customers. Obviously, service companies will not have materials inventory. When the business sells its product or services on credit, this results in what is called an account receivable. Since the account receivable represents the company's right to receive payments from customers in the future, it is an asset or a resource of the company. Slide 19, which will be the last one for this particular video, is on operating activities. This slide shows how expenses and liabilities are related. We will be discussing this in more detail later in the course. In the description of expenses, the cost of goods sold includes the total product costs, which in the manufacturing business will include labor, material, and overhead charges. Net income or loss is the so-called bottom line of the income statement. That is, it represents the final results of business operations for the period in question, whether it's a month, a quarter, or a year. With that, this portion of the Chapter 1 overview concludes. The remaining slides will be covered in the second presentation.